Welcome back. So in this video, we're going to talk just a little bit about the differences between venture capital groups and private equity. Okay. So venture capital, and again, you look at at what time in the company life cycle are we investing. Venture capital groups, that's what we mean by stage. At what stage in the company life cycle are we investing? So venture capital groups normally cover three primary stages. There are some venture capital groups that focus on seed companies, okay? Companies in the seed stage. Again, these are, maybe they don't even have a product yet, but they're getting there. We've talked about how, in some of the other videos, what these different stages are between seed, startup, and expansion, which is almost probably more in their growth and maturity phase. But the ones that focus on seed companies, again, are looking for brand new ideas, maybe developing technology. They're probably going to be investing $1 million or less in this particular company. Okay? The ones that focus on startup companies, the venture capital groups that focus on startup companies, are going to be making larger investments. So usually like $1 million to $10 million. Again, because it's in the startup, they probably have at least some sort of a minimum viable product. They're trying to move into the growth phase. And so a little bit more capital is going to be required to help them get over that hurdle from startup to growth. That's a little bit more costly expenditure than moving from seed to startup. So therefore the investment will be a little bit bigger. And then the ones that are looking at expansion are probably going to be looking at somewhere between the range of $10 million investment to $100 million investment. And again, this is when you've got a relatively well-established company. It's in the growth or maturity phase probably, and maybe it's looking into moving into a new market, looking for the next big thing for this particular company. So venture capital groups will focus on any one of these three stages. Compare that to private equity. Now, there's three primary types of private equity that we look at. They're going to be looking at growth. Okay, that's kind of like the expansion for venture capital, but we're looking at much larger investments, right? We're looking at $100 million plus normally with private equity. So we're going to be looking at companies that are looking into maybe moving into a brand new market or brand new industry. These are well-established firms that private equity invests in. These are not really what we would call entrepreneurial ventures. Okay, they may be looking at leverage buyouts or buyouts in general, but they're normally known for leverage buyouts. And a leverage buyout is kind of a mix of equity and conventional loans. And so what they do normally with these leverage buyouts, that's why I call it leveraged, is they'll borrow money from a financial institution, the private equity group will, and then they'll use the stock in the company that they've bought as collateral against that loan, right? So they're basically using speculative instruments, speculative investments as collateral on their loan. I know it's really crazy to think about, right? But that's what these buyout groups are looking at. And then there's also ones that focus on turnarounds. So they maybe take a company that's kind of failing or dying and they find some way to revamp it and then make it profitable again. Okay. One of the greatest examples of private equity that I can think of is when Warren Buffett teamed up with 3G Capital, which is a private equity group, and they basically bought Heinz, and then they bought the shares of Kraft, and then they created together the company Kraft Heinz. Now, when I mentioned Warren Buffett and 3G Capital, those are the major investors, and this is something that's common to both venture capital and private equity. Is a lot of these groups, when they're investing, they like to go in with several different investors at once. So, like, let's say you've got one VC fund that's looking at an expansion. Again, you're looking at 10 million to 100 million euros. Maybe they don't want to foot all 100 million euros of that investment. So they may team up with several different venture capital groups, and maybe each of them contributes like 10 or 15 million euros or 10 or 15 million dollars each, so that they can get that number that they need. Same thing with private equity. They may partner up because, again, you're talking about huge investments, and on one hand, it's the potential to make a lot more money if it goes well, but it also increases a degree of risk if it goes under, right? So they do like to partner up. Now, when we're looking at venture capital companies, they tend to focus, again, on the tech, all that Silicon Valley stereotypes you're making. They tend to look at things in the telecom industry. They may look in the media industry, or also biotech and pharma, right? Pharmaceutical companies, biotechnology companies. That's where they tend to focus. Again, there's always exceptions, don't get me wrong. When you look at private equity, you're looking at more traditional businesses, large industrial companies, those in consumer goods. Again, a great example of that is the Kraft-Heinz merger that happened a few years ago. I mean, and again, these are staple products. That's what we call consumer goods. You know, you're looking at Kraft for like cheese and milk and, you know, a lot of processed food, you know, Heinz with ketchup and sauces and things like that. So, you know, these are, some people might call them boring companies, and the reason that they do is because you're looking at the growth of these particular markets. So when you look at things like consumer goods or industrials, you know, 3M, Johnson & Johnson, whatever, you're looking at pretty low growth or growth that matches what an overall country's gross national product is, right? You know, this maybe be single-digit growth or less, well, single-digit growth, okay? When you're looking at market growth for venture capital, you're looking at usually double-digit growth. Again, because it's new markets, you may be looking at 10, 15, 20% market a year because the market itself is developing. Again, think about effectuation. The market itself grows because you're starting to get new customers, you know, you're refining the ideas, and the market will continue to expand. Now, when you look at the expected return of these two groups, again, like anything else in entrepreneurship, you can potentially get 50 to 60% annual growth with venture capital. Again, you're thinking about, you know, you're looking for those home run companies, those companies that are really going to be the next Amazons, the next Facebooks, the next Microsofts, etc. That's why this growth rate is so high. But again, with that comes a lot of uncertainty. When you look at the kinds of investments that private equity makes, they're investing in pretty well-established companies and normally pretty well-established industries. So yeah, they may be getting 20 to 40% annually. It is less. Okay? But again, they're looking more at it from a risk perspective. They've got data that they can use and they can make calculations. Okay? Now you're also wondering the difference between venture capital and corporate venture capital. What's going on there? Well, the venture capital, those, again, as we've talked about already, those are just the funds themselves. Okay? Corporate venture capital is a venture capital fund that is sponsored by a large corporation. And why would a large corporation do that? Again, large bureaucracies get kind of stale. They lose that innovation edge. So, large corporations may start their own accelerators and may have their accompanying venture capital funds that go with it so that they can get, you know, get those brand new ideas on the frontier, right? They can get those creative entrepreneurs in. And you as an entrepreneur might be really excited about being in corporate venture capital. Why? Okay? Think about this. You know, this gives you an opportunity to partner with one of the giants in your industry. You get all of their resources, you get all of their connections, you get all that power that goes with it, right? You're basically getting all the resources that an employee of that particular company would get. That's really cool. And again, you are probably tapping into your future customer. You're working right there with them. That sounds really cool. Now the bad side from the entrepreneur's perspective, of course, is the fact that you are at that company's mercy. Okay? Because, again, because it's corporate venture capital, they are investing in you. They probably own a very significant portion of your company. So it may take them a long time to make a decision, right, on, you know, whether to help you or not. And again, you may not have 8 months to wait because, again, the market is changing, growing so quickly. So you may not have that 8 months that a corporation has when they make a decision. Alternatively, they can make a quick decision and decide that whatever you're doing no longer fits with their strategy, and then you're kicked out. Or even worse, you've got a fantastic idea and a competitor wants to buy you out. Too bad, because you belong to this particular corporation. Okay? So those are kind of the pluses and minuses from the entrepreneur's perspective of belonging with a corporate venture capital group. So these are the main decisions, or main differences between venture capital and private equity. Most of our discussion from now on this playlist, we're going to focus a lot on the venture capital side. And I'm looking forward to seeing the next video. As always, if you like this video, give me a thumbs up, that's a like. Hit that subscribe button or comment down below. Fantastic. I'll see you in the next video.